In this video, we'll be going through 3 different methods of inventory cash flow methods. But before we do that, let's first ask, why are inventory cost flow assumptions important? The simplest answer is because they affect the cost of goods sold and ending inventory, which are 2 key financial statement items. The cost of goods sold is a major expense on the income statement, and ending inventory is an asset on the balance sheet. What are the costs of goods sold? Simply, they're just total cost of the inventory that a company sells during a period of time. Now let's start with the first method, average cost method. Imagine you have a store that sells apples. You buy 100 apples for $1 each on Monday. On Tuesday, you buy another 100 apples for $1.20 each. You want to know how much each apple costs so you can sell them for a profit. The average cost method is a way to figure out the average cost of each apple. You do this by adding up the total cost of all the apples and dividing it by the number of apples. It will look like this. Now let's move on to the next method, the FIFO method. FIFO stands for first in, first out. It's a fun and easy way to keep track of inventory. Just remember that the first items you buy are the first items you sell. Imagine you have a bakery and you sell bread. On Monday, you buy 10 loaves of bread. On Tuesday, you buy another 10 loaves of bread. On Wednesday, you sell 5 loaves of bread. With FIFO, you know that you sold the 5 loaves of bread that you bought on Monday. So the cost of goods sold for Wednesday is the cost of the 5 loaves of bread that you bought on Monday. Here's an analogy to help you remember. Imagine you have a stack of pancakes. You put the oldest pancakes on the bottom of the stack and the newest pancakes on the top of the stack. When you're hungry, you eat the pancake from the top of the stack. FIFO is like a stack of pancakes. The oldest inventory is at the bottom of the stack, and the newest inventory is at the top of the stack. When you sell inventory, you sell the oldest inventory first. Now let's move on to the last method, the LIFO method. It stands for last in, first out. It's another way to keep track of inventory. It assumes that the most recently purchased items are the first items sold. Now let's see what this looks like in a real-life situation. Now try to keep up with me. Pause if you need to. Imagine you have a store that sells generators. You buy a generator on January 1st for $1,000. On February 5th, you buy another generator for $1,200. On March 1st, you sell a generator. Under the LIFO method, you would assume that you sold the generator that you bought on February 5th. This means that the cost of goods sold for March 1st would be the cost of the generator that you bought on February 5th, which is $1,200. So, there you have it. 3 different ways to keep track of inventory: average cost, FIFO, and LIFO. Which method is right for you depends on your specific business and your goals. If you're looking for a simple method to use, then the average cost method is a good option. If you're selling items with a short shelf life or perishable items, then FIFO is a good choice. And if you're looking to reduce your taxable income in times of inflation, then LIFO may be the best option for you. No matter which method you choose, it's important to be consistent. This will help you track your inventory more accurately and make better business decisions. Thanks for watching. If you have any questions about inventory cost flow assumptions, please leave a comment below.